Have you ever wondered where the money comes from to build our world? The smooth roads you drive on. The schools where our children learn, the hospitals that care for us when we are sick, do not appear by magic. They are paid for by taxes. Taxes are the money we all contribute to build a society that works for everyone. It is a shared responsibility. When everyone pays their fair share, our communities can thrive. We can have safe streets, clean parks, support for those who need it most. This system is based on a simple promise. We all chip in, and we all benefit from the services that make life better and safer for all of us. To understand the problem, we must first learn two very important words: tax evasion, tax avoidance. They sound similar, but they are different in the eyes of the law. Tax evasion is illegal. It is when a person or a company deliberately hides income or lies to the tax authorities to pay less tax. An example, a restaurant owner takes cash payments but does not report that cash as income. This is a crime. If caught, that person can face large fines, even go to jail. Tax evasion is like stealing directly from the public purse. Tax avoidance, on the other hand, is different. It is the use of legal methods to reduce the amount of tax you owe. The wealthy and large corporations hire teams of expensive lawyers and accountants to find loopholes in the tax code. They look for gaps and special rules that allow them to move money around in ways that minimize tax bills. For example, profits can be shown in low-tax countries. This is often perfectly legal. It is not about breaking the law, it is about bending the rules of the game to your advantage. The line can be blurry. What one calls clever planning, another sees as aggressive and immoral, and many schemes operate in a gray area unchallenged. One of the most common tools used to avoid taxes is the offshore bank account. While the term might conjure images of spies and illicit dealings, the reality is often far more mundane, yet just as impactful. At its core, this is simply a bank account located in a country other than the one where the person lives. For some, there are legitimate reasons to have one, perhaps for managing international business transactions or protecting assets from political instability back home. However, for the ultra-wealthy seeking to minimize their tax burden, the appeal lies elsewhere. They turn to jurisdictions often called tax havens: Switzerland, the Cayman Islands, Panama, Singapore. These are just a few of the dozens of countries and territories that have built thriving economies around financial services. They attract trillions of dollars in foreign capital by offering two main attractions to the wealthy: secrecy and low or zero taxes. For these havens, the business model is simple. Charge fees for company registrations and financial services, creating high-paying jobs for lawyers and accountants, all while fueling a local luxury economy. The tax revenue they forego on foreign capital is more than compensated for by the sheer volume of money flowing through their system. The first pillar, secrecy, is paramount. Strict banking secrecy laws can make it very difficult, and sometimes nearly impossible, for foreign tax authorities to know who owns an account or how much is in it. Historically, this was the era of the anonymous numbered Swiss bank account, a cliché rooted in a very real system of financial privacy. With this veil of secrecy, a wealthy person can move millions of dollars offshore, and their home tax agency may never even know that money exists. The income it generates, interest, dividends, capital gains, remains invisible and, therefore, untaxed. But to make things even more secret, and to add powerful layers of legal separation, the wealthy often use another indispensable tool: the shell company. A shell company exists only on paper. It has no office, no employees, and it produces nothing. Its sole purpose is to own assets on behalf of its true owner: money, stocks, real estate, yachts, or even fine art. When registered in havens with lax ownership rules, the true owner can be hidden behind nominees, local lawyers or agents who act as the public-facing directors, or even other shell companies. This creates a complex, nested structure, like a Russian doll of ownership, making it a forensic nightmare to trace the money back to its source. For ultimate protection, a third instrument is often added: a trust. This legal arrangement allows the owner to transfer their assets to a trustee, who manages them for a beneficiary. By placing the shell company inside an offshore trust, the wealthy individual can legally claim they no longer own the assets, further insulating them from taxes and creditors. The structure becomes a person controlling a shell company, which is held by a trust, which in turn holds the offshore bank account. Let's look at a simple example. Imagine a wealthy business owner named Alex. Alex sells a commercial building for a $10 million profit. In their home country, this profit would be subject to a significant capital gains tax, potentially costing millions. But Alex doesn't own the building directly. It's owned by Oceanfront Holdings Limited, a shell company Alex secretly controls, registered in the British Virgin Islands. The buyer pays the $10 million to the shell company, which then deposits the money into its bank account in Switzerland. From the home tax agency's perspective, Alex never personally realized a profit. The transaction occurred entirely offshore, between a buyer and a foreign entity. As far as they can see, the profit never happened. No tax is paid. Now, you might ask, aren't there rules against this? In recent years, global pressure has led to new regulations. Programs like the U.S. Foreign Account Tax Compliance Act, or FATCA, and the Global Common Reporting Standard, or CRS, require banks in participating countries to identify foreign account holders and report their information back to their home tax authorities. This is known as automatic exchange of information. In theory, this should make hiding money impossible. But in practice, the system is riddled with loopholes. Some tax havens have been slow to implement the rules, while others don't participate at all. And the use of complex trusts and shell companies can still obscure the true beneficial owner, allowing the wealthiest to slip through the cracks. The system is only as strong as its weakest link, and there are many. This combination of offshore accounts, shell companies, and trusts forms the very backbone of the global tax avoidance industry. It's a sophisticated parallel financial system built by and for the ultra-rich, operating beyond the reach of the rules that apply to everyone else. Beyond shell companies, another powerful and often misunderstood tool in the tax avoidance toolbox is the trust. While many financial instruments are complex, the basic idea of a trust is surprisingly straightforward, yet its implications are profound. So, what is it? A trust is a legal arrangement where a person, the settlor, gives control of their assets, like property, stocks, or cash, to a trustee. This trustee, who can be an individual or a financial institution, then manages these assets for the benefit of a third party, the beneficiary. The key idea is the separation of ownership. Once the assets are in the trust, the settlor no longer legally owns them. Now, trusts have many legitimate and important uses. They can be used to manage wealth for young children, provide for a relative with a disability, or ensure funds are set aside for a specific charitable purpose. In these cases, they are invaluable tools for responsible financial planning, but this same legal structure can be exploited. When a trust is set up in a secrecy jurisdiction, it becomes a formidable device for hiding wealth and avoiding taxes. The critical distinction often lies in whether the trust is revocable or irrevocable. A revocable trust can be changed or terminated by the settlor at any time. Because they retain this control, the assets are usually still considered part of their estate for tax purposes. An irrevocable trust, however, is different. Once the settlor places assets into it, they permanently relinquish ownership and control. It's a one-way street, and this is where the tax avoidance potential truly emerges. Let's imagine a very wealthy individual. We'll call her Maria. She has a billion-dollar art collection and a vast stock portfolio. To shield this wealth from future taxes, she could place these assets into an irrevocable offshore trust. She appoints a professional trustee in a tax haven like the Cayman Islands and names her children as the beneficiaries. Now, on paper, Maria no longer owns the art or the stocks. The trust does. Inside this offshore structure, the portfolio can grow, generating dividends and capital gains, all potentially tax-free. When Maria passes away, there may be no inheritance or estate tax to pay on these assets. Why? Because legally she didn't own them. The trust was the owner, and the trust doesn't die. The trustee can then distribute the assets to her children according to the terms she laid out. In this way, immense wealth can be passed down through generations, largely untouched by the taxes that ordinary families pay on their homes and savings. It's a system of preservation for the few, built on laws that are technically legal, but sidestep the principle of fair contribution. For multinational corporations, the strategies are different, but the goal is the same: minimize tax. The main game is called profit shifting, and intellectual property, or IP, is often the star player. This includes things like valuable brand names, software code, and pharmaceutical patents. Here's a classic playbook. A large parent company, let's call it Global Corp, develops a highly valuable patent in a high-tax country like Germany. It then sets up a subsidiary in a low-tax jurisdiction, say Ireland. Global Corp sells this valuable patent to its own Irish subsidiary for an artificially low price. This is a key step known as transfer pricing. Now, the Irish subsidiary officially owns the lucrative IP. Let's follow the money with a simplified example. Imagine Global Corp's German branch makes 100 million euros in profit from sales. Normally, this would be taxed at Germany's corporate rate. But now, the German branch must pay a massive royalty fee to the Irish subsidiary for using the patent it now owns. Let's say that fee is 98 million euros. On the books, that 98 million is a business expense in Germany, which slashes the German branch's taxable profit to just 2 million euros. All other Global Corp branches around the world, in the US, Japan, and the UK, do the same. They funnel huge royalty payments to the small Irish subsidiary. Meanwhile, these royalties, hundreds of millions of euros, pile up in Ireland. There, they are taxed at a much lower corporate tax rate, or sometimes through further complex structures, not at all. The money was earned from customers in high-tax countries, but the profits are booked and the taxes are paid in a low-tax haven. This is the architecture of modern tax avoidance. It is meticulously planned, executed by top-tier law and accounting firms, and shockingly, often perfectly legal. But it starves public services of essential funding in the very countries where the real economic activity happens and where the bulk of the company's customers and employees live. The system that allows for so much tax avoidance did not appear by accident. It is built on laws full of loopholes. Gaps and exceptions arise by mistake, and often by design. Powerful corporations and wealthy individuals spend millions lobbying to influence politicians and officials. Small changes, a deduction here, an exemption there, add up to a system that favors the wealthy. An army of experts specialize in tax planning and wealth structuring, setting up shells, offshore trusts, and complex international entities. This creates a massive inequality of arms. The average person can't afford this. Their taxes are taken straight from the paycheck. Tax treaties, meant to prevent double taxation, are often exploited. Money is routed through multiple countries to chip rates near zero. Treaty shopping. Most strategies are technically legal and within the letter of the law. But do they follow the spirit? That everyone contributes a fair share? By moving profits without real operations, the basic principle is violated, using complexity to dodge responsibility. Yeah. When the wealthiest pay less tax, the consequences aren't abstract. They hit ordinary lives. Less funding for schools, larger classes, outdated books, overworked teachers. Poorer neighborhoods fall further behind. Healthcare suffers, longer waits, less research, fewer public health programs, outdated equipment, A loved one's illness can become a financial crisis. After exploring the intricate shadows of tax avoidance and evasion, it's easy to feel overwhelmed, even cynical. But the good news is this: the problem is not unsolvable. This isn't a fight against an unstoppable force of nature. It's a challenge created by human-made rules, and it can be fixed with better ones. There are clear, practical, and proven steps we can take to restore fairness and ensure everyone contributes their share to the societies that enable their success. These aren't radical, untested theories. They are common-sense reforms, many of which are already being debated and implemented in pockets around the world. The goal isn't to punish wealth, but to rebuild the foundations of a system where prosperity is shared and sustainable. The single most powerful tool in our arsenal is transparency. Secrecy is the oxygen that tax avoidance breathes. To suffocate it, we must shine a light. The cornerstone of this effort is the creation of a global financial register, a comprehensive, interconnected database that lists the ultimate beneficial owners of every company, trust, and foundation. Imagine a world where you can no longer hide vast fortunes behind anonymous legal structures. This register would make it clear who truly owns what, from a skyscraper in London to a portfolio of stocks managed from the Cayman Islands. It would give tax authorities, journalists, and the public a clear view of wealth and ownership, dismantling the architecture of secrecy one entry at a time. This leads directly to the next step: ending the era of the anonymous shell company. For too long, these empty corporate vessels have served as the primary vehicle for hiding assets and evading taxes. By requiring that every registered company discloses its true human owner, we give authorities the fundamental information they need to do their jobs. But information alone isn't enough. We must simultaneously strengthen our laws, closing the loopholes that have been exploited for decades. This means replacing convoluted, thousand-page tax codes with clearer, simpler rules that are harder to misinterpret and abuse. The principle should be straightforward. The spirit of the law must be as binding as the letter. For multinational corporations, the solution is to tax them based on their real economic activity. This means looking at where their sales are actually made, where their employees truly work, and where their factories and offices are physically located, not just where their accountants have parked profits on paper. Sophisticated schemes that shift billions in profits to a tiny office in a zero-tax jurisdiction by charging fictional royalty fees for a logo would become obsolete. If a company earns $100 million selling phones in Germany, it should be taxed on that profit in Germany, not in Bermuda. This simple, substance-based approach aligns tax obligations with genuine business operations, ending the absurd fiction of the global profit-shifting game. To make this a reality, we must expand and strengthen the automatic exchange of financial information between countries. When a citizen of one country has an account in another, that information should be sent to their home tax authority automatically, not after a lengthy legal request. We must also enforce meaningful penalties for non-cooperative tax havens that refuse to participate. This could include tariffs, sanctions, or restricted access to global financial markets. Crucially, we must adopt a global minimum corporate tax. This creates a floor, stopping the destructive race to the bottom, where countries compete to offer ever lower tax rates, eroding the tax base for everyone. A global minimum ensures that no matter where a multinational books its profits, it will pay at least a basic, agreed-upon rate of tax, removing the primary incentive for profit shifting. None of these rules matter if they aren't enforced. For decades, tax agencies have been systematically defunded, leaving them outgunned and under-resourced against armies of high-priced lawyers and accountants. We must properly fund enforcement, equipping agencies with the expert staff and advanced technology needed to audit complex global structures. This is not a cost, it is a high-yield investment. Studies consistently show that every dollar spent on tax enforcement can return $5, $10, or even more dollars in recovered revenue. money that goes directly to funding public services. It's one of the most effective investments a government can make. Reclaiming fairness is a shared responsibility, and it begins with governments. They hold the power and the duty to act. This means having the political courage to write and pass strong laws, to sign and ratify international treaties on tax cooperation, and to properly fund the agencies tasked with enforcement. Critically, it means resisting the immense pressure from powerful corporate and wealthy lobbyists who have a vested interest in maintaining the broken status quo. This is the fundamental test of a government's commitment to its citizens over special interests. The legislative agenda is clear: pass laws that mandate public beneficial ownership registries, close the specific loopholes that enable profit shifting and the use of shell companies, increase transparency requirements for corporations and trusts, fully empower tax agencies with the resources and legal authority they need, and at the international level, work tirelessly to build a global consensus against harmful tax competition, forging a united front that makes it impossible for any single actor to undermine the system. But governments rarely lead, they respond. That is where citizens come in. We can and must demand change. We can support political candidates and reformers who make tax fairness a central plank of their platform. We can join and donate to watchdog organizations and investigative journalists who expose wrongdoing and hold power to account. We can raise our voices in our communities, write to our elected representatives, and most importantly, we can vote with this issue in mind. An informed and engaged public is the most powerful lobby of all. The financial industry, the banks, law firms, and accounting giants that facilitate these complex structures must also be part of the solution, not just the problem. This requires more than just token gestures. It demands stricter internal oversight, robust know-your-customer protocols, and a fundamental cultural shift away from the mindset of, if it's technically legal, it's okay. True corporate responsibility means refusing to engage in schemes that, while legal, clearly violate the spirit of the law and harm society. Finally, international organizations like the OECD and the United Nations have a vital role to play. They can set global standards for transparency and tax policy, monitor progress, and publicly call out non-cooperative jurisdictions. They also provide a crucial forum for negotiation and cooperation, helping to build the consensus needed for global initiatives like a minimum tax. Furthermore, they can provide technical assistance to developing countries, helping them build the capacity to collect the taxes they are rightfully owed, which are often the funds most desperately needed for development. Ultimately, this isn't just about complex laws, accounting jargon, and vast sums of money that are hard to comprehend. It's about something much more fundamental: fairness. It's about the integrity of our basic social contract, the implicit agreement that we all contribute to the system that protects and supports us. It's about the roads we drive on, the schools that educate our children, and the hospitals that care for us when we are sick. When that contract is broken, the legitimacy of the entire system is threatened. A system where nurses, teachers, and firefighters can end up paying a higher effective tax rate than some billionaires and multinational corporations has profoundly lost its way. It breeds resentment, erodes trust, and starves the public services that are the hallmark of a civilized society. But the rules of the economy are not laws of physics, they are choices. We design the current system, and we can choose to redesign it. We can choose a future built on simple, transparent, and fair taxation. A future where profits are taxed where they are actually made, and where that revenue is used to serve the public good, creating opportunity and security for everyone. The path forward is clear, and the solutions are known. What has been missing is not knowledge, but will. The journey requires sustained political will from our leaders, deep international cooperation between nations, and the persistent, unwavering demand of active and informed citizens. The choice is ours to make.